Let's focus in on the gold story. Rich writes in and says, I want to know where gold is going in 2010 with the US dollar falling as well as UK possibly raising rates. Any feedback appreciated? Well, we can do a whole lot better than that. We've got Charlie Morris with us. He's head of absolute return at HSBC Global Asset Management. And last time we saw you, Charlie, you were mega bullish on the gold price. Are you still as bullish as you were?
I still am. I'm not sure in the short term that I'm particularly excited, but I think over the next, because it's had a big move, but I think in the next 5 years or so, what we've got is the highest quality asset on earth, and I think there's a stampede for diversification. The central banks have now joined the frame, and I think this story is not over until a typical portfolio has 5 to 10% invested in gold.
You say over a 5-year story, so what is your strategy in the medium term now? Do you think that where we are at the moment is about the right price going into 2010? I mean, give us some short, medium and long-term trading behaviour.
Sure. So we've come from 270 or so all the way to 1,000. We've consolidated that price for 18 months. We've come through a credit crisis. In most currencies it went up during that credit crisis. It's the only asset in the world now trading at an all-time high. I think you put all those factors together, people love a long-term, low volatility trend. They then extrapolate it into the future, and that's where it becomes a frenzy. I think that frenzy has now begun. I think it goes on for quite a long period of time. I have no idea where it goes in 2010, but I'm assuming it's upwards.
But you'll have heard many of those who say, in dollars maybe, but if you look at the gold price in other currencies, it doesn't look, the line-up doesn't look quite as impressive.
It's still remarkably impressive. As I've made the point many times before, 80% of the gold price rise in the last 10 years can be explained by gold going up, and only 20% is the dollar going down. So I think the dollar story is now remarkably irrelevant.
And what would you say is the prime argument for owning gold today? The one that drives your interest in it? Because we hear so much about inflation hedge. It's a currency to replace those paper currencies that are being debased.
It's the highest quality asset in the world. Simple. Very, very simple. Doesn't mean to say it's the best investment long term. Not at all. It's the highest quality asset on earth. Financial asset, real asset, whatever you want it to be.
Can I add a point to my own defense here, if I may? I know the viewers have always taken me to task on gold, and probably quite rightly so, because it's the one asset class that A, I probably am most interested in, but B, probably understand the least. I will say this, I have been wrong, entirely wrong, and if you go to the website, you'll see that I've penned an article about the gold movement. It's called The Great Gold Surge Mystery, and the tagline is, one thing's for sure, the precious metal remains a key component in any investment portfolio. I have been overcome with the gold story. But I will say this. 2 things. Firstly, in 1933, gold traded at $32 an ounce, and the Dow was roughly around 50. In 1980, gold hit 850, and the Dow closed at 873. There's a tiny little unscientific correlation between the Dow and gold price. And actually, John Hathaway, who's a gold fund manager at Tocqueville, says that he thinks gold is actually 9 times undervalued because the Dow is now at 9,800.
Sure. The Dow-gold ratio and all that, the relationship between risk assets and risk-free assets, long-term risk-free assets, not short-term risk-free assets. Big difference here. I think the way to value gold in the long term is to compare it to a loaf of bread, to an acre of farmland, to a house, to a cost of a haircut, these sort of timeless ideas. Yeah, and there's quite a few of them can come out. Some of them are, so you can't say on air. But there are quite a few things that you can measure which are pretty timeless. And I think that is the NAV theoretical value of gold, if you will. Then you add or subtract the speculative premium or discount. And I think right now we're probably in NAV terms still quite low compared to history. And I think we've got to get to that price and then the speculative premium.
A very quick analogy. A friend of mine a long time ago was one of the first people I ever met who traveled to the former Soviet Union with a consultancy firm. And she came back, and one of the things she told me was that a small piece of advice: carry loads of $1 bills, because nobody can break anything larger than a 1. If you have a 20, that's what you're paying for a cup of coffee. Gold, as a transactionable commodity, would have great difficulty in the most extreme environment, because what are you going to do with a brick of gold?
Buy a lot of coffee.
No, sorry, that's not satisfactory, Charlie. It has to be a transactionable asset, and that's gold's one great disadvantage. You can't transact in it. You can't pay your taxes in it. You can't buy all of those things that you've just described to me in it.
Yeah, but I'm not talking about Armageddon here. We're talking about, you know, a relatively normal world where we're talking about putting some gold into a portfolio. I think there's a funny idea that gold is either ridiculous and worth nothing, or, you know, it's got to be worth everything in hyperinflation and guns in the woods scenario. There is middle ground where we have a sort of muddle through times. You know, there are lots of problems out there. We know about those. You know, something else has got to find its way into the portfolio. Something has got to be the best thing to own in that environment, and it's gold.
Yeah, I mean, help our viewers a bit on this, because to Martin's point, and I agree, you know, let's not get over fixed up about, you know, do you buy a gold bar or whatever. But, you know, if you're a viewer out there and you actually believe the gold story, you know, how should you go about investing in it? I mean, from your, you know, would you say to somebody invest directly in the physical? Would you say to somebody go and invest in a producer? How do you think people should invest in gold?
Well, a quick advert break, if you don't mind. HSBC is the largest gold bullion dealer in the world, and 80% of the world's ETFs are held in HSBC's vaults. So you can buy an ETF in the London Stock Exchange. There's PHAU would be the one that's tax friendly for onshore people. There are others as well out there. Some people don't like those. They like the Swiss ones because they think that Switzerland's the place to be in a real crisis. Some people would say, like James Turk would say, you shouldn't actually own an ETF at all. You should actually make sure you go and see it in the vault and write your name on it. And so there are various theories about that. I would think the ETFs are very safe. I think they're a good way to invest in gold. But I also think you can consider gold mining shares. Now, right here, right now, gold mining shares are really cheap. They just haven't moved in the last couple of years compared to the gold price. And I think one of the problems is that they're really bad companies, essentially. They've got lazy managements, and every time the price goes up, they raise capital. And so, you know, in terms of shareholder friendliness, they don't really tick the boxes like Coca-Cola does or something like that. And so the price goes up, and I think that they've lagged behind. They're very cheap, but you know the price is going to go so high that they can't stay down. And it was made, one more point, Jeff. The point was made to me that in the 1970s, what you paid for gold shares, you received in dividends at the top of the bull market.
We've got to let you go, Charlie, but thanks very much for coming in. Charlie Morris, Head of Absolute Return at HSBC Global Asset Management.